But if you take a 30,000 foot view of gold, that base fiat currency system is 95% down its days. Whether gold is going to go up to preserve your purchasing power, to allow you to keep some of your wealth from confiscation, or if gold is going to run amok through the roof, these are two possibilities.
Monaco 64, home of alternative economics and contrarian views. Today, I have a person who's been, in the financial markets for over 40 years. He's an entrepreneur. He's got experience in corporate and investment banking. And his name is Andre Jakubovic. He's based in Brazil, but he's worked all over the world. And he's been on the channel before with Clive. But we're going to cover today what Andre is seeing in terms of the markets, the economy, the elections, geopolitics, and the Fed. Andre, welcome back to the channel. How are you?
Happy to be here, Mario.
Great to see you. So can we start talking about the dollar and the Fed and all this speculation that we're seeing that the Fed needs to cut rates? Some people are saying they might even do it next week. I think it's July 31st. We're talking here Thursday, the week before the Fed. So yeah, if you can start with that.
Yeah. Well, I happen to think that the Fed has put itself in a corner for many different reasons. One particular reason is that the Fed bases its monetary policy on inflation numbers. And as we are all aware, as we go to the supermarkets, as we spend our money on a daily basis, we're aware that these inflation numbers are somewhat underestimated. So there is inflation pressure. We can see commodities going back to the upside. And particularly yesterday, we saw the inventory numbers for oil and gas and energy. And it appears to us that oil and gasoline and diesel and all these components of inflation for energy, they've been kept in check by sales of inventory. The drawdowns as of yesterday were quite large, which implies that oil prices, gasoline prices, diesel prices, which have a big effect on inflation, it implies that they're being kept under management artificially. That being said, going back, inflation numbers are somewhat, they grossly underestimate real life prices. So based on that narrative, the Fed keeps on telling that they've risen rates and kept them high long enough, and that an easy cycle is on the way. One of the things that you have to put into perspective is that the Fed is under severe pressure from the European Union, Canada, Japan, to lower rates, because these vassal currencies of the US dollar, their economies is not humming along like the US economy is as of we speak, even though at the expense of these narratives. So there might be issues with banking systems, economies, and all sorts of risks from abroad that depends on Fed easing for them to live another day. And here's the thing. According to what we can tell from now, the market is pricing in the Fed starting to ease, if not in the following meeting. Some say there might be a couple, if not 3 Fed cuts still this year. The intensity of these cuts will depend on whether there's an event or some issue within the financial markets. But the Fed has been vocal in a subtle way. The Fed has been vocal about saying we have some tools to deal with the banks. We have specific tools. We've been doing some engineering. We're ready to solve the CRE debt problem if and when necessary, as if to say to the markets, Fed policy is doing good. We're about to start easing rates. The vassal currencies, they will like this. And based on the inflation numbers and the near-term trajectory, we're on to a soft landing as good as it gets. That being said, some issues here. One thing the Fed is aware is that it's very likely we're going to have a second wave of inflation because commodity prices are telling us so. Recent inflation numbers, they're not only cooked, but they've been helped by these, I'd say, energy manipulation of prices through selling of oil and gasoline reserves. And so the Fed, simply put, they need to lower rates. They need to keep a credible narrative of sorts in order to help the other currencies. And if and when they get a second wave of inflation, then we'll see. They don't have a solution for that. So the base case for right now is, yeah, there might be some problems brewing in the financial markets. The Fed has its toolbox ready to go. So do European Union, so does the Bank of Japan, the Bank of England. There might be a little more inflation in these countries, a little less economic growth, meaning a lot more pain in Europe, in Japan, and Canada. But they have to understand for the time being that if this fiat currency, if this dollar-based fiat currency system is to live another day, they have to withstand this kind of pain for a little longer until the Fed is ready to print, okay? So I think there's some kind of cooperation going on where the economic pain in these other countries is much bigger, much less growth, much more inflation. But it's necessary to put up with that for a while longer, at least until the elections. That being said, I think the Fed also is worried about not only the second wave of inflation, which he's going to deal with going forward, but he's also doing something that is the most problematic for the whole system, which is the US Treasury bond yield curve. As of yesterday, there was a bloodbath in risk assets, and the yield curve, the US bond yield curve, was acting up a little bit. There was movement in the short-term end of the curve as much as it was in the long end of the curve, suggesting that we might be facing a bear steepener. What does that mean? To my understanding, what happened yesterday is that they are suggesting stagflation in the US. Higher than optimal inflation, lower than optimal growth. And what the Fed has done in order to keep the yield curve under control, not to spook risk assets, not to spook the banks, they have been doing severe suppression of duration bonds. So it's been a long time since they tried to sell 5-year, 10-year, 20, 30-year. And the last time that they tried to sell 5, 10, 20 years, there was a big tail. And markets saw that and like it one bit.
So that was sorry, just for the viewers. So that was the US Treasury. They're cutting back on issuing the longer term paper. And is the Fed as well probably not unwinding their balance sheet with long-term paper either? So suppressing duration. It's like they're trying to even almost do like yield curve control to keep the longer end down. Is that it?
They're basically suppressing supply of bonds. Like you mentioned, the Fed's QT program has been downgraded. The US Treasury is no longer offering long-dated bonds. The Treasury has been offering notes. And as they offer these notes, they suck up all the liquidity that's sitting idle, waiting for something to happen. Because equity prices are at all-time highs, there's still a lot of liquidity in the system. And most of that liquidity, Mario, stems from two items, which are not sustainable. One is $2 trillion in fiscal deficits on a yearly basis, and roughly $1.5 trillion in interest servicing costs, that interest servicing costs. So the US economy is being flooded with roughly $3.5 trillion from these two items. And those items are ending up sucking up the Treasury notes that Janet Yellen keeps offering while avoiding the long bond. Because if you think about it, everybody knows these inflation numbers are not real. So today, for you to go out and buy a 10-year US Treasury bond yielding 4.25%, it is a short loss in terms of purchasing power. So they understand, they already admitted, tacitly admit, that the bond market, the long end of the bond market is broken beyond repair. So they're avoiding issuing new bonds, and they're avoiding the QT at the Fed is no longer releasing these bonds back in the market. So what they did, to answer your question, is they're basically cutting off the supply, but that comes at a cost. The short end of the curve, you have to float these notes at 5.5% per annum, which is helping to balloon debt servicing costs even higher. For your viewers to have an idea, the debt servicing costs today in the US, they take up 30% of tax revenues. That's 30%. So we're going on a fast track to flirting with hyperinflation. If you look back in history, and you're an expert in this field, you will know within history at which point debt servicing costs versus revenues had to go until things got out of hand. I don't think it's 100%, but there has been cases, real cases, where it will come a time when tax revenues will be 100% needed for paying interest. And that's when all bets are off. Important to know that the Fed must keep on this muddling through agenda, because if you have a crash in equity markets, there is a loss of revenue, tax revenue from capital gains, which is by far the biggest item for the IRS. And that would expedite this fiscal doom loop of sorts, okay? So it's very important to your viewers to know that this tragic fiscal path the US is going through is happening while officially the US is not in a recession. But if you think about a recession where tax revenues go down, Social Security costs go up, and there's still stubborn inflation because, you know, the numbers we're looking at are cooked, there might be a situation where the Fed might have to print in the face of inflation where its tax revenues are gone, and it becomes quite complicated for the world on a global scale, because it's the global reserve currency that we're talking about.
Yeah, so
Uh,
sorry, go ahead.
Go ahead. No?
No, so you're
I was going to say one last thing I was going to say about this uh, uh, suppression of duration is that the longer you keep this game on, it will come to a point where, like we had in Brazil back in the 80s, think about the US, United States, rolling its debt on a daily basis.
Yeah, Brazil was called the overnight, wasn't it?
The overnight, 100% of Brazil's debt was being financed on a daily basis. This has happened in Argentina. This has happened in every single inflationary country, hyperinflationary country. I'm not saying the US is anywhere near, but it's going there at an amazing pace.
Yeah.
If you take an X-ray of the debt profile of the United States, I'm not sure if my memory fails me, but I guess 50% or so, it's already maturing in less than a year because of these policies to keep the yield curve under control.
Yeah,
so they're doing
not only
they're
buying
do
short-term notes, but they're also buying like the short-term T-bills. And
they're avoiding new issuance
yeah,
of long-term notes. They're no longer doing QT at the same pace for long-term notes, and this ramping federal debt is being financed 100% via notes. And it came to a point, like I was saying, if I'm not mistaken, about 50% of the entire government debt of the United States is short-term maturity at a high rate of 5.5. It's incredible, but I don't know how they're going to get out. The exit strategy out of this, I'm not so sure, but I think that's what we are looking at least until the elections.
yeah, and
And
the worrying thing, sorry, about what you just said is this is happening when they're not in a recession. And why that is important for the viewers is that in a recession, tax receipts drop massively because, like you said, the stock market drops and there's no capital gains tax collection. People lose their jobs. Yeah, so it's really, yeah,
so social security costs go up.
wow, yeah,
So it's kind of like a perfect storm. You might have stubborn inflation due to geopolitics, supply chains, this whole rearrangement of the global trade. So there might be stubborn inflation. There might be shortages, while at the same time, they will have to print to pay for all that stuff, to plug that big, big hole that keeps on growing. So going back, to see the US Treasury on a fast track to finance its deficits in the short-term market, it's akin to a pre-yield curve control of sorts. So if you were to say we are already in a yield curve control based policy, except that it's not exactly like you see it in Japan, and there will be a cost. There's already a cost for doing that, and it's the most direct cost is the debt servicing costs, which keep going higher. They're now up to 30% of all revenues. But there might be bigger costs going forward, because if you have falling revenues in a recession and your debt is due in a few months, you have quite a bit little breathing room, if you understand what I'm saying. So this is what is unfolding. We have to watch and see. Maybe you'd like to talk about what might happen between today and the elections. maybe what hard assets have to do with that and how I see this going forward, because the pace at which hard assets are going to take control, and they will, it's not a straight line.
Yeah,
because they're
the day we're talking today on Thursday, the 25th of July, and we've had gold has dropped quite a bit and silver's dropped quite a bit. We've seen oil and copper. So a lot of people are thinking, oh, we're going to have a collapse of the markets and gold and silver are going to crash. I'm not too sure that's going to happen. I mean, yesterday we did have a big down day in the market. So yeah, we can talk about that. And I'm sure the viewers want to see what you think about that and why gold, silver, and hard assets. Why do you think they're going to do so well going forward? Still, well, keep doing well. They've been doing quite well since March 2020.
So let's talk about gold. What happened yesterday when markets were crashing? Gold prices might have been reacting, but not for the very same reasons. The gold market might think markets crashing. There's wealth destruction going on. Gold is going to lose price because gold is an inflation hedge. So gold players, when they saw the market crash yesterday, they thought, hey, there's deflation incoming. Let's, water down in our positions. I see this as noise. I don't see signal. There's no signal there. If you think about the gold markets, which are heavily manipulated by the banks and the exchanges, there are many parts of actors in the gold market, okay? Think of it this way. You have, say, an individual who can walk up to his gold dealer and buy some sovereigns, keep it in his house, in his safe, whatever. Okay, that's one layer of the gold market. Then you have the spot market for gold in London, in Chicago, where you can buy and sell spot gold and keep it in custody, whether it's there or not, who knows, but there's a spot market. And then there's a humongous, much larger futures market and a derivatives market for gold. And that's where it starts getting interesting, because the futures market is extremely more liquid than the spot market. The options market allows you to do all sorts of arbitrage by issuing covered calls, all sorts of financial engineering to take advantage of arbitrage opportunities in the market. So, for example, one might want to buy gold spot and sell gold futures. The spot market has one size, the futures market is a lot bigger. So if you want to do a big position and arbitrage a spot market versus the future, let's say I can buy gold at 2,300 in the spot market in Chicago, and I can sell in the futures market for a 12% annualized profit. I lock in my profits. But for you to put this position in your books, you are buying spot in a less liquid market, and you're selling futures in a much more liquid market. So depending on the position size, the futures market will not be affected as you sell, but the spot market might move as you buy, and vice versa. When you unwind this position, you might be able to square your futures position, but as you try to square your spot position, prices might move around quite a bit. So I would say that because you have all these layers, all these actors, the short-term price action for gold is noise. I think the most important element in understanding the value of gold as a commodity is that it's an inflation hedge. And what gold investors must understand is that it's not about I bought gold at $800 and I was able to hold it till 2400. This is not the primary purpose of holding gold. The primary purpose of holding gold is to protect your purchasing power. So if you look on a long-term horizon, you will get what you are supposed to get, which is protecting your purchasing power. Everything else is timing, is, luck, whichever. That being said, Mario, I was thinking about you the other day because you've done a great job for so many years, and you've done a great service to your viewers. And here's something I'd like to share with your viewers, which is something you're not expecting this, but I'll tell you what. Think about it as follows. If you look back in history, which you're a great teacher on that subject, you have all these books, all these passages, all sorts of historical facts that you share with your followers. I was thinking about this yesterday, and out of coincidence, you invited me here today. And let me tell you this. If you look back in history, these fiat currency systems, even back in Rome, when they had the silver and they had the gold, it takes time for these schemes to run their course. So what would I say to your viewers today? This gold standard was done away with in 71. We are in 2024, and until recently is the first mathematical signal that time is up for this 7 year, 71, about 7 years?
53 years.
This 53-year-old scheme has reached what I call fiscal dominance, which is a mathematical certainty that this money is going to be debased. We are in the digital age, so it doesn't take time for everyone and their mother to be aware of this. The BRICS Plus are aware of this, so they're trying to build their own system, a gold-based system for that matter. So what I'm trying to say is, if you're waiting 56 years, try and understand that we have reached a stage where this thing, we're going to live to see what's next. It's a mathematical certainty. They're going to fight it to the tooth. They're going to maybe confiscate gold. They might want to try to keep this ball rolling for another 3 to 5 years. But it is what it is. They will not, just, oh, I'm tired, pull the plug and let it burn. It's not going to happen that way. It might burn all of a sudden because there's a power struggle in the US. There's a tremendous geopolitical stress on a global scale, and geopolitical stress has to do with this power struggle that is going on also in Europe. So yeah, we might all of a sudden see it implode, but that is not to anyone's interest. I'll give you an example. China has to decouple from the US. China has a pickle at the South China Sea regarding Taiwan. The US has been poking China every way they can. They're telling to cut your manufacturing. They're telling them to stay away from Taiwan. They don't want them to have access to high-end chips, all sorts of stuff. And then all of a sudden, the likes of Apple decided to shift from China to India for their iPhones. Guess what? It didn't work. The iPhones are shitty. They malfunctioned. They had to stop production. They went back to China and they redone all the partnerships that they have. So think about it like this. The US, does the US really think they can decouple from China and do to China what they did to Russia all of a sudden? And then what? Their economies are strongly connected. And China, the same thing. China doesn't want to escalate against the US because they're holding 800 billion in US bonds alone. not to mention other trillions of dollars in US investments and vice versa. So this unwinding has to be orderly, which is the interest of the United States and the interest of China. But if something happens where the Chinese are pushed towards the exits, which it seems the United States is trying to flirt with by militarizing the South China Sea, then it's going to be disorderly. But the real message to your viewers is we came to a point where we know what we've been saying, that it has been the case throughout history. We know it's going to happen. So now it's time to, stay safe and hold on to your gold. Hopefully physical gold would be the best, because gold held in custody anywhere is at risk. It will be at risk. Maybe less risk than holding fiat, but there might be a situation where, I can't give you the physical gold. Here is $5,000 for your ounce of gold, but that $5,000 that you get is going to fast debase into whatever. So physical gold, to have some physical gold is important. And like I said, it's been 50 some years. I think we're 90% there. I think 90% of this debt-based fiat currency that's been going on since 71 is behind us. What I'm saying is maybe more than 90%, Mario. Maybe 90%. What that means is this is going to unwind in less than 5 years, likely earlier. Why would I say likely earlier? There's an outside the box scenario from today until the elections in the United States, that I think the Democratic Party sees a change in power as an existential threat to them, for many different reasons, which we may avoid to talk to and not go into the specifics. But once those in power understand there is an existential threat, they become very dangerous. I could connect the dots between, the assassination attempt against Trump the other weekend. But what I'm trying to say is there might be a situation where, as opposed to muddle through, by having these programs available to the banks, by holding rates higher a little longer, keeping equity markets at all-time highs, while understanding the pain that must withstand the likes of Europe, Japan, Australia, Canada. So to reset the markets after the election, okay? But then again, if they believe they cannot win the election, plan B is on the table, and then all options are possible. They might implode the market.
Bring the house down, burn everything up, because
look, for you to pull out something, for you to pull out a black swan, you have to put people in fear. You have to put people in a situation that they will accept anything as opposed to starving to death. So this is something that a lot of people are watching carefully, and the probability of this burn it all down scenario is not negligible. Again, we had this cyber blackout of sorts, which is extremely fishy. I look into the details and the circumstances. I don't think this was an accident. It might have been a warning of sorts. To what extent the entire world could be made hostage to a cyber attack, where banks, airports, supermarkets, everything go offline. That might be in the cards. Escalation in the Middle East, it looks like it. Like if you watch what Netanyahu did yesterday and what was going on with the protests in DC, and his speech and the reaction from the Democratic Party against Netanyahu, I was mentioning to you offline, those in power are funding what Netanyahu is doing in the Middle East. He came to Congress, he got a standing ovation. He did a speech that is as woke as it can be. It was as if he was promoting the Democratic Party. But the protesters outside who were vandalizing Washington were Democrats funded. Pelosi came out and said that Netanyahu's speech was the worst in history. It was a shame. So the very same who are in power, which allowed Netanyahu to do what he did, who invited Netanyahu to come to speak at Congress, are those who are complaining about Netanyahu and funding the protesters against Netanyahu. So I smell potential escalation in the Middle East as yet an option for them to burn it all up before the elections. I mentioned the cyber attack. I just mentioned the Middle East. And of course, there's Europe. I think Europe is kind of less hot than the Middle East right now, maybe because they have decided to blow it up through the Middle East. And they understand that poking Russia is a lot more complicated. They don't have the means, not kinetic means or financial means to do so.
Maybe Iran, don't you think?
Well, the thing with Iran is that it's not in, look, the power players, we don't know where they are, but we have a guess. The power players are in Western Europe and in the US, or those who are running the US. So given the stage of events in the Middle East, it might have been pragmatic to think that, you know, fighting Russia is going to lead to nuclear disaster, if not the devastation of Western Europe. We don't want that. We want to keep Western Europe habitable. If we destroy Lebanon, if we destroy, Iran, and war breaks out in the Middle East at the expense of Israel, we escalate. We have what we need to cancel elections, to cancel civil rights, to create conscription, to fight wars, etc. Stay in power and preserving Europe from a kinetic war and move on.
We'd get a lot higher prices as well of oil if there's some kind of conflict vis-a-vis Iran, because I think they'd block the flow of oil through the Hormuz.
Which would kill the Fed.
Yeah.
And the point is, if they are in a corner and staying in power is an existential threat for both leaders in Europe and in the US, to do something like that, which would definitely kill any chance of orchestrating a soft landing of sorts, they would do this to stay in power and never leave. They're going to have to create an event where people will accept anything because the options are terrible. So this is my outside the box analysis for what might happen. I hope I'm wrong, between now and the elections. It isn't what makes this threat credible, Mario, is I am convinced that the Democrats don't have the votes. They never did. And there's a way for you to win an election in the US by creating conditions in certain battlegrounds, in certain states, and in certain districts within those states. Except for what happened last election, your opponents are watching it now. They're doing stuff to make this very difficult. So whether the Democrats are going to pull it off again or not, at what cost, whether they will get away with it or not. So the risk here is not the risk, but the question. If the Democrats believe they can elect the likes of Kamala Harris by creating the right circumstances under in certain states and certain districts, which are considered the swing vote, they will go for it. But if they think that the door has been shut for them to pull this off, then all options are on the table, Mario. And like I said, if I'm right about that being an existential threat to them, we better buckle up and watch.
Yeah, and do you want to talk about the battle within like the deep state in the US, because you think there's different factions, or you want to leave that for another day?
Well, it's up to you. I was going to talk a little bit more about gold. Like I said,
Oh yeah, maybe gold, and also if you could talk about what you think, what is the danger of holding mining stocks, even though we're bullish
look,
gold, you know, counterparty risk and all that.
Look, I'm not right nor wrong about what I'm going to say, because it has to do on each one of us appetite on a risk adjusted basis. Okay. So the way I see the global landscape today, the junior miners today, under the circumstances, considering credit, cost of money, environmental issues, all the politicking, and all sorts of external factors, the junior miners have a very challenging path to consolidating themselves as miners. The big miners, they have capital, they are well established to withstand these headwinds: cost of money, lack of credit, environmental issues, geopolitical issues, government power grabs, all sorts of risks that the big miners may suffer, but they will somewhat find a way to make ends meet. The junior miners have these headwinds. They're much more vulnerable. So what I'm trying to see is that when you talk about investing in miners, I see a tremendous amount of risk in the juniors for the reasons I said, because they're a lot more vulnerable. But if they get it right, if they can, step aside these hurdles and they hit the jackpot, you're gonna 100 extra money, maybe 1,000 extra money. So, for those who understand gold for what it is, I think investing your money in the junior miners or in the miners is a complete different investment proposition than buying gold. You understand? Buying gold is to protect your purchasing power and have self-custody of some gold against confiscation. Buying miners is like buying Apple stock. Plain and simple, two different games. And like I said, I spoke to Clive Thompson about this. I don't think it's productive for gold advocates to talk about the relevancy of gold right now that the fiat currency system is in its final legs, and put the miners in the middle of the conversation. Because you end up confusing your audience, because people who want gold for protection are the last kind of people you would want to have buying big or small miners. So it's a different investment thesis, even though the underlying is the same. One thing is to take gold off the ground, refine it, and have the final product. Another thing is buy gold. Two different theses. I would say they are opposite to each other.
Yeah, I agree with you. And I mean, I do have some minors, the big ones and some junior, but it's a very small proportion of what I have. And
Exactly.
like you said, it's all about your risk profile. And I think sometimes we get a bit greedy because we think, oh, gold's going to go to 3 or 4,000. The miners are going to do a lot better. But gold going to 3 or 4,000 is already really good. It's like what other thing can you hold not in the financial system that goes up like that, and you don't have to worry about fees and talking to a
Mhm.
broker. I mean, maybe your home, your house, and the real estate, but your house you have to live in. Gold is like you can liquidate it, and so
I
I
agree.
agree with you. It depends.
One thing about your home, first of all, it's not your home. You have to pay rent. You have to pay the taxes on a yearly basis. You cannot bring it with you. Your mayor might decide to triple the taxes on your home. Your mayor might decide to confiscate your home so you can have room for some illegal aliens who are ruthless. I mean, there are certain risks of owning your home that you don't have in holding your gold uh, when you have it in self custody. So even a home, uh, the cost to protect your home is a lot higher than the cost to protect your physical gold.
Yeah, and physical gold, you hold
You
it
can,
for
and
10.
you can bury it somewhere.
Yeah, and it doesn't tarnish, or you don't have to upkeep it like a home. Put a new boiler in or
There you
something like
go.
that. But yeah.
Yeah, but then again, the problem with the fiat currency system is that because they can debase the money at will, a home starts to become an investment as opposed to a roof over your head. You bought your home for 200,000 pounds. It's the very same home. You've kept it in the very same stage when you bought it, and now your home is 600,000 pounds. So I ask you the question: what did you change the plumbing? Is it now all of made of gold? It's not. So the value of the home appreciates is proof that your currency is being debased. That's all.
A lot of people don't see
So
that. Here in the UK, people just say, well, there's nothing better than bricks and mortar. But they don't realize that it's the currency that's
no,
getting.
no, no. It's may I add to this equation because you're not wrong. Let me explain.
No, no, they're
Think of
not.
no. Let me explain. Let's say you have an inflation rate, official inflation rate that is 3%. Okay, but you go every day on the streets and you see that the real inflation rate is a lot higher. My kids' school tuition has doubled in price. The food grocery bill has doubled, tripled in price. And people must remember that when you have lower inflation, it means it is expanding at a slower pace. It's not going down, it's still going up, only slower. Plus, people must understand that these fake inflation numbers that do not connect with reality, even those numbers, they compound. So if you have like 6% inflation rate on an annual basis, within a few years, everything has doubled in price. But let me get to the home. So let's say you were to buy a UK government bond yielding 6%, okay? And you have an official rate of inflation of 3%. So you think, well, I'm making 3% above inflation. But they tax that 6%. You have to pay taxes on that 6%. So at the end of the day, you are earning a little less than 3% because of taxes. So you're losing a little bit against this inflation. Except this inflation rate is cooked up. Real inflation is maybe 4 times higher. And by the way, may I remind you, it compounds over time. So Where does the housing market come in? People start doing the numbers and they realize that in spite of taxes, in spite of property taxes, in spite of inheritance taxes, whatever, owning and keeping a home, I go poorer slower than buying a UK government bond. So it's not like homes is a solution. Home might be the least worst solution when comparing with holding financial assets. You see, for you to make good on your money, you're not going to do it in the bond market. You're not going to do it in the housing market. You have to go to the equity market. And not only that, Mario, you have to find the winners. You have to pick the winners. If you look at the S&P 500, it's been pari passu with them too for decades. What the S&P 500 is a mirror of expansion of the money supply in the US and on a global scale for that matter. So you not only have to go and take risk in the equity markets, but you have to pick the Amazons when they're cheap. What's peculiar is that people are buying NVIDIA today because of its fundamentals, regardless of price. When you have an algorithm that takes everyone's 401k every month and do an automatic allocation into the most liquid and most prominent assets within a certain index, you're going to get inflows to NVIDIA no matter at what price. So we're in a stage where not even fundamental analysis does it anymore. So like I said, I think this Fiat scheme is in its final legs. For those of us who's been watching this for decades, we got to have a little patience because these people are not going to let it implode unless they have to or they want it to implode. And one big possibility is whatever happens between today and presidential elections in the US in November.
Yeah, I agree. I think I've noticed that the mainstream media is saying that Kamala Harris is ahead of Trump in some polls or neck to neck. So they're really trying hard to big her up. I think maybe in a month's time, if they see things are not improving, then we'll see the beginning of the takedown of everything.
No, I think it's worse than that, which might avoid a takedown. You see, what's happening today is that the mainstream media is starting to pull the rug on Kamala.
Already.
Black Lives Matter, yeah, Black Lives Matter came out officially blaming Kamala for telling Kamala for being incompetent to be president. And you know, it's kind of crazy because the parry line is she's going to be the first black woman, black female president of the United States. And BLM should help this narrative. And they came up and said, no way, you're not fit for the job. Okay. Now the mainstream media is embracing Kamala's weakness because she was the border czar and nothing happened. It got even worse. And the mainstream media all of a sudden decided to embrace this narrative against her right now. Okay. And the best part is Barack Obama. He came out yesterday vocally saying he thinks she doesn't have what it takes to win. And my guess, Mario, is that she's the placeholder. And until August 19, when is the DNC convention, there's going to be a new candidate, and that's not going to be Kamala. And I have my bets on Michelle Obama.
Well, there's been a lot of rumors about that for many months, actually. I've heard that before. So yeah, any final words today for the viewers?
I like to, yeah, I like to tell gold, those who are invested in gold, I like to tell them that I find it tremendously cynical from those who look at short-term price movements in gold and try to convert it into some sort of signal. Because like I was saying earlier in our life, price formation for gold is extremely complicated. There are many different actors. But if you take a 30,000 foot view of gold, that base fiat currency system is 95% down its days. Whether gold is going to go up to preserve your purchasing power, to allow you to keep some of your wealth from confiscation, or if gold is going to run amok through the roof, these are two possibilities. One might prefer that things remain civilized and gold just creeps higher for longer, slowly but surely, with a bits of ups and downs, making its way. Gold potential, if you take an X-ray photograph of the US financial system, public finances today, gold should be worth $60,000 to back it all up. So if we were capable of, backstopping this huge amount of fiat currency out there by allowing this debt to implode and inserting gold into the system organically or over time, which I think China would like, everybody would like that. I could see a bull market in gold for the next 5 to 10 years. But to your viewers, I hate to say, if history is any guide, these changes are not orderly, Mario. And that's where wars come in play. I think we looked at everything. I really enjoyed this, by the way, because I think it helped me organize, what's coming next.
No, that's great. I really enjoyed it too. Great. Andre,
Yeah.
thank you for accepting my invitation. And we have to speak again, maybe about some more controversial issues, and we could put it maybe on Rumble.
Yeah, we can do that. And also we might come to talk again soon, because I think within a few weeks from now, if not sooner, there will be some new elements to this conversation there.
Great. Thank you, and take care.
Thank you. Bye-bye.